Welcome back. This is Judith Paquette, and the topic is closing the books. And where does this fall in the accounting cycle? We have done all the journal entries, the T accounts, the adjusting journal entries. We've created a final trial balance and final financial statements, and now it is time to close the books. And what that means is get the balances out of revenue, out of expense, out of dividends into retained earnings. We're going to make 4 journal entries, then we're going to post them to the T accounts, and then we're going to create a post-closing trial balance to check our work. So here's the trial balance we just looked at in the adjustments, part 3. And you'll notice that we've got prepaid insurance and insurance expense listed here, but they have 0 balances. So it's important to note that if an account has a 0 balance, you do not need to list it on the trial balance, so we'll take it off there. A company can have many more accounts than show up on the trial balance, but this is just putting the ones out there that have a balance. Now I am going to leave retained earnings on there, and it does have a 0 balance, but that's just for the first month of business. After that, it will always have a balance, and that's just kind of to remind us of that. And remember, we publish the financial statements. We always start with the income statement. Then we transfer the balance of net income or net loss onto retained earnings. We recalculate the ending balance of retained earnings, and we report that on the balance sheet. And here you see it. Here's our net income for Emerald City Design, $2,755. And here's retained earnings, again, beginning balance because that's of 0 because that is its first month of business. Plus net income, less dividends, and we're going to show that as a negative. Ending balance, $2,155. And you can see that here, $2,155. At the end of the accounting period, the company has to get ready for the next period. Permanent accounts, assets, liabilities, stockholders' equity are not touched. The temporary accounts, revenue, expenses, and dividends must be closed. They have to be reset to a 0 balance and all ready for the next period. When we talk about the accounts, again, we really are talking about the individual accounts here. We are not talking about the account categories. So it's important for you to note that every time we do a journal entry, we do it at the account level, not at the category level. So let's get started. Here's the trial balance we just looked at. And to do the closing journal entries, we just draw a line under the last balance sheet account. The closing journal entries are going to take all of these accounts to 0. So if dividends has a $600 debit balance, we're going to credit it $600 when we do our closing journal entry. Revenue has a credit balance, so we'll need a debit in our journal entry to bring it to 0. Let's get started. So again, the closing entries formally recognize the transfer of net income or net loss and dividends to retained earnings. So I'm going to show these closing journal entries as of the end of January 31st. Normally these are done at the end of a 12-month fiscal year. Now, I'm not going to walk you through 11 months of activity to get to these closing journal entries, but you get the idea. So retained earnings right now has a 0 balance. And we're going to transfer this profit into retained earnings, and we're going to transfer this dividend into retained earnings, and retained earnings ending balance is going to be $2,155 when we are done. And that way, when we're done with the closing journal entries, all of these balance sheet accounts have a T account with these same balances, common stock as well. And after the closing journal entries, retained earnings T account will also have a $2,155 balance. So what you see on the balance sheet will be accurate. Let's get started. The first journal entry is to close the revenue account. So we're going to transfer the ending balance in all the revenue accounts to income summary. Now, we only have one revenue account, service revenue, but if a company had more than one, you would add it to this journal entry. So we're going to debit service revenue, and credit income summary, and this will close the revenue account. Income summary is only used for the closing of the revenue and expense accounts. It is a new account for you, and it is one we only use in the closing journal entries. Journal entry number 2. Transfer the ending balance in each expense account also to income summary. So remember, the expense accounts had debit balances. So to zero them out, we need to credit each one individually. Add up all those credits and debit income summary. So you simply cannot write expenses $6,195. You have to empty out each T account individually, just as if you had 6 buckets partially filled with water and I said empty each one out. You'd have to go to each bucket and empty it out. So let's post those 2 entries. Here's service revenue. You can see the earlier activity, you can see the adjusting activity, and now the closing journal entry. And it's transferred over to income summary. Income summary is debited for the total of all the expense accounts, and each expense account individually is emptied out. And look at that balance in income summary. That is equal to net income. Closing journal entry number 3, we close the income summary account. So we take the ending balance in income summary and transfer it to retained earnings. We're going to debit income summary for that same number, profit, and we're going to credit retained earnings. Now, some companies would take those first 2 journal entries and just say, let's skip income summary and post it directly to retained earnings. Most companies do not, and I will tell you why. Most companies prefer to have a separate journal entry showing the transfer of profit or loss to retained earnings, and that creates an audit trail. And here we are posting those journal entries. Now income summary has a 0 balance and retained earnings shows profit in it. Let's do our final journal entry, and that is to transfer the balance in dividends to retained earnings. Dividends does not use income summary because dividends is not part of the calculation of income. So we debit retained earnings and we credit dividends. And here you have that 4th journal entry, and look at the ending balance of retained earnings. It now reflects what it says on the statement of retained earnings, and dividends has a 0 balance. So we have created our closing journal entries. Now let's take one last look at the T accounts for the entire chart of accounts. You will note that all of these balance sheet accounts did not change with the exception of retained earnings and dividends. Well, dividends is not a balance sheet account, just retained earnings. And you will see that all the revenue and all the expense accounts now have 0 balances. So let's create a new trial balance, and you will see that all of these accounts have the same ones they did in the final trial balance, with the exception of retained earnings, which now carries its ending balance. And the revenue expense accounts, if you have done this correctly, should have a 0 balance. Now you'll see these totals are not the same as the adjusted trial balance totals, and that's okay. That's because everything went into the credit side of retained earnings. This ends the video closing the books. Our next video will be the classified balance sheet. Thank you.